Welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research. Okay, it's day 2 of this government shutdown, day 2 of Q4 in the month. I'm just wondering, how you and the team are assessing everything right now, given the market's reaction that it seems investors think this is all going to sort of blow over and it doesn't really impact the Fed's path forward.
Thank you very much for having me on this morning, Sam. We do think that it complicates the Fed's path forward. So the reason being is that we've heard recently from the Fed that they are very data dependent, and the data points that they're focusing on is the labor market. Now, we have the non-farm payroll report that normally would come out tomorrow, but because of the government shutdown, we know we're not going to get that. We also would normally get weekly jobless claims today, but again, because of the government shutdown, we didn't get that. So looking forward, I just think it complicates where the Fed wants to go, and they'll likely have to put more weight into kind of some of those other reports that we recently have gotten. So for example, we got the ADP report, we also got challenger job cuts today, and both showed that the labor market's softening. However, normally in normal times, the market wouldn't put too much weight on those two reports. But given that we don't get the bigger reports, we'll see how much the Fed puts into that. So again, I do think that it is something that complicates how the Fed reacts. And also a very important point is, what is the duration of the shutdown? So how long does it go? If we get those reports prior to the Fed meeting later this month, maybe it's a moot point, but we'll see.
Yeah, you make such a fantastic point about the fact that, the Fed is data dependent. How can you be data dependent if you're not really getting the data that you should normally rely on? But, if we look at the market reaction function, Coop, as far as what they're pricing in, investors right now, you're still looking at more than a 90% chance that the Fed's going to cut these rates come October. So it just feels like, all but done for now. Are you surprised by the reaction in what we've seen in the market?
I am moderately surprised that last I looked on Bloomberg functionality, it's about 100% probability. So I'm a little bit surprised that it is fully priced in, because we do still have inflation elevated. That is a risk for the Fed if they cut too aggressively and too fast. They don't want to risk it's causing inflation to spur and move out of control. So I do think that it is somewhat surprising that the market is priced so favorably for those rate cuts. Now, obviously the bias, and I agree with your previous guest, that the bias for the Fed is to cut rates. We're in the camp right now of one more rate cut this year, but depending on how the market develops or how the data develops, if we get that data. So I do think that the bias, though, is that the Fed is going to continue to cut rates. Now, when and by how much, that's obviously the question that's out there in the market right now, Sam.
Okay. And what do you make of what we've seen as far as the reaction in the bond market then, Cooper? We saw a bit of flip-flopping yesterday between 409 and 412. They're holding pretty steady on the 10-year, the benchmark today. Just wondering what your thoughts were when you look at the yield.
Yeah, so our expectations for yield, Sam, is if we look at longer term yields, we believe that they're likely to be range bound. Given that lack of data and lack of things to push the 10-year Treasury one way or another, I think that's really going to be the big thing to watch, is that it is likely to hover right around that 410 area. Maybe it dips a little bit below, but I think right around that 4% area seems relatively appropriate, given that we're kind of flying without most of the information that we normally would have. But if we look at the short end of the yield curve and trying to look out further of what could happen longer term, we do expect that that's going to move lower. So we're in the camp that the yield curve should continue to steepen. That's really been a theme. That's been a theme among a lot of strategists this year. So if we do get those Fed rate cuts as we expect, whether it's 1 or 2 this year and how many into next year, our expectation is that that should pull shorter term yields down, Sam. So one of the things that we've been discussing with some of our clients is to consider moving out of those cash positions if they have large cash allocations and locking in some of those yields, because we do still think that absolute yields at these levels can be attractive.
Right. Okay. So you're anticipating to see the curve continuing to steepen, but very much led by the short end and that lowering there. I'm just wondering, as we look at this U.S. government shutdown and the impact that it's having on the market. It looks like they've largely shrugged it off. You say you're surprised about the full pricing in of, potential for next Fed rate cuts. I'm just wondering at what point, what would be the catalyst as we continue to examine this shutdown for some concern here. We've heard about furloughs, whether it is sort of mass layoffs that could start to chip away at the GDP, which has been holding up. I mean, it has looked resilient, particularly when you look at the consumption, the retail sales figures as well. What are you keeping an eye on the most?
Yeah, you are correct. So if we look at the last GDP revisions, obviously they were very strong. So that was good for the economy. But if we focus just directly on the impact of the shutdown, I think there's a couple of things to watch. The first is, sadly, this isn't the first shutdown that we've had. So we've already kind of seen this playbook play out. And in the past, markets really shrugged off shutdowns. The second piece that I'm watching is the duration. I think that that's going to be a very important piece, because if it's a very short-term shutdown, then the market will likely shrug it off like it has in the past. If it's longer term and it does have an impact to payrolls and maybe federal payrolls, I think that that could more potentially have a risk to the market. But we really don't know, and we'll have to see, is that just a negotiating tactic, or is that something that could actually come to fruition? The other piece about it is, in the past, the reason that it hasn't had that much of an impact is many of those employees who were furloughed got back pay for it. So even though it was a temporary hiccup, eventually they got refunded, or they got their paychecks back. So that's part of the reason why it hasn't been a major hiccup in the economy in the past.
Okay, keeping an eye on that duration, because if it is dragging on, I mean, it does come into question, what other data could very much be delayed, and then that could cause a bit of a headache as far as the lack of visibility. I suppose that's the view out there. Cooper Howard, always a pleasure. Thank you so much for joining us. Appreciate your time. Director and Fixed Income Strategist over at the Schwab Center for Financial Research, joining us there.